Folks, we have got to talk about a Barron article that Taylor from Life Goal Investments sprung on me last minute, talking about 8 more rate hikes. We're talking a Fed funds rate at some crazy number, 8%. And we also have some of the market predicting 4 rate cuts. Neither of these can be true, or at least they both can't be true together. I actually think both are wrong, but it is wild to think about 8 rate hikes versus 4 rate cuts. That is quite the dispersion. What's going on?
And when you think about this, you're 100% right. So this is written in Barron's, which is probably the #1 financial publication there is. That and the Wall
No
Street
doubt.
Journal, 6 in one hand, half dozen in the other. So this is not some scrub off the street that's putting out this projection. He thinks there is real risk that we get Fed funds rate, which currently sit at 4.25 to 4.5, at somewhere between 6 and 6.5%. So he is talking about potentially 8 rate hikes coming down the pike. And to your point, what
Wait,
the
hold on,
broad
hold on,
market.
hold on. Fed funds, isn't Fed funds 5 to 5.25? Is he talking
I'm
about
sorry, did I
treasuries?
say?
You said
Yeah, yeah.
4.
No. I just misspoke. Sorry. Thank you for correcting me there.
Oh,
5 to 5.25.
okay.
So, okay, then I have to walk back my comment
Yeah,
too.
isn't it?
And,
Yeah.
and
Where
now
are
we're
we at?
talking about, I'm not sure where that number came in my head from. So now that we're talking about that, we're talking about, again, 4 rate hikes versus 4
Okay.
rate cuts.
Oh, that makes me feel a little better. Not much
Do we
better,
want?
but a little better. So basically he's talking about going to 6.5% Fed funds.
Correct. 6.5% Fed funds. Right.
Okay, so 6.5 Fed funds given the current mortgage separation means we could almost be at a 10% mortgage rate.
Yeah, because it's like 300 bips, right? From a
Yeah,
30 year.
307, 311, something like that. That's
Yep.
for best credit. That means most of us are over
Yikes.
10%.
Yikes, that is just bananas, isn't it? So yeah, I think the reality of it, what we're looking at here is like there is such a wide dichotomy of what's playing out between the expectations from some and the market, what the market's pricing. And we talked in the last episode about how the market prices, but the market is pricing right now 4 rate cuts to come in 2024 and 0 rate movement this year. So the market's saying the Fed's going to keep interest rates
Fed's
flat this
done.
year
Yeah.
and then cut 4 times next year. Whereas this gentleman, who is obviously an expert in his field and he's an economist, says he can see up to 6.5%. So that's another 100 basis point higher. So we're 8 rate,
Yeah.
eight rate hike cut difference between the two sides right now. And what
So
does
let's,
that do?
yeah.
What does that do? Like that causes an absurd amount of volatility, potentially an absurd amount of onus and responsibility on Jerome Powell, because right now it's so wide and he has to figure out, okay, some people are expecting this, some people are expecting this. Likely he's going to come in somewhere in the middle, but he's got to walk those people in the direction of each other as he tries to get the market to move where he wants it to be before he cuts or rate hikes.
Yeah, so let's just play this out. I think rate cuts, I think everybody knows or has a general feeling what kind of plays out there because most people are there, I think. Let's talk about this idea. I haven't read anything. I got to go seek out this article. 4 rate hikes coming. So obviously we'd have to have a strong economy. The GDP now print would have to be, 4%. Probably Q4 has to be strong as well. It's not a one and done thing. So we probably have to exit the year in the 3s for the entire calendar year, which is pretty good for the US economy. Job unemployment rate probably has to stay sub 3.8, right?
I mean, we're at
JOLTS report.
3.5. I don't know how we could get all of that growth and not maintain. Like I
Yeah.
would say that it might not even tick up. It could tick down further.
And then, so let's just play this out. So 6% mortgage or Fed funds, 6.5 Fed funds. What does that do to the stock market, right? If you're in tech, specifically growth tech, that can't be good.
Well, what's been interesting is that 2022, obviously, growth tech got smoked. And 2023 comes around and they're continuing to raise rates, earlier this year, and they just paused, right? But they continue to raise rates up until this point. And so what you had was the large growth companies that don't have to finance their debt
Exactly.
operations. So you look at like
Yeah.
an Apple, a Google, a Microsoft, those
The
names that
Magnificent
have just
Seven. Yeah.
hordes of cash sitting around. Normally, high-tech growth stuff gets hammered when rates go higher, but they held up really well this year. Obviously, it's been a
Yeah.
banner year for them, but under the surface, stuff that is rate sensitive because they have to finance a balance sheet for future growth has been crushed. And
Yeah.
so I think that there's kind of a dichotomy that plays out there, that the cash hoarders and those that are just revenue generating, free cash flow generating have been insulated a little bit, but that historically has not been the case. All of growth has gotten hammered with higher rates historically.
So, I think unprofitable or not cash flow positive tech is just gets smoked in that environment. Why would you go there when you get 6% or whatever? So then I think about banks. And again, we're not, this is the problem with freaking things going on. The big are going to get bigger. Everybody else is going to get hurt. Think about the balance sheets at a community bank, even a regional bank. Shoot, a super regional bank. You gobbled up all these treasuries. And now, can you imagine what those would be worth? They got to be down 40%.
Yep. Yep.
I mean,
And
if you're
so
at,
here's an interesting one. I sat with a banker last week who's a good buddy of mine. So he's a good buddy of mine, and he works at a larger community bank. It's
okay.
community regional. I'm not sure where the line is there, but he was talking about the bank in Kansas that failed. And
Yep.
he said, what you don't realize is why that bank failed. He's like, one, they were obviously stressed from higher rates, like everyone is in the community and regional bank space. But he said it just took one thing. It was one piece of fraud that ended up get sent out to some account that was not the right account. And all of a sudden, the bank just took the hit on the balance sheet. They wired out, and I don't know how much money, say $1 million. I have no idea what the dollar amount was, but they couldn't take $1 million hit on the back end. And those mistakes happen to banks. So when your margin for error becomes
Oh,
razor thin based on interest rates moving up and your bond prices moving down and your lending being restricted, et cetera, and then you have this one-off event that takes place that does happen, boom.
pretty wild. I mean, think about being a bank in this environment. And again, we're just playing a game of what if we get 4 more rate hikes.
Right.
Your balance sheet is worth less if you had to mark to market. There's talk, if not already done, it's coming, more regulation, which equals more expense on the income statement. Your
Yep.
revenue is taking a shit because you're not lending to anybody. You're having to pay
Correct.
higher interest rates because you're competing with money market accounts and the big banks for security. And you're one whoops away from a freaking everybody moving their money with their phones. I mean, the next 2 years for that tier of banks gonna suck.
Yep. Yeah. And there's just got to be, and we've mentioned this ad nauseum now, but there's got to be consolidation. There has to
Oh,
be consolidation.
it's gonna
We
be
have
a mess.
4,600 banks in this country. Most countries have, a handful of banks, a few handfuls of banks, and we have 4,600. And they do serve a very valuable purpose. Like small businesses account for 99% of the businesses in the United States and about 50% of the overall economic output. And
Mhm.
these banks service small businesses. So if they start to have continued contractions and issues, et cetera, the likelihood that that small business is going to be able to get a loan from that bank is just not as high. And so we need to see some consolidation. I'm a free market guy and all that, but the free market's going to drive some of these banks out of business. So what's going
Oh,
to
I have
happen
to.
is the government's going to come in and say, you guys need to come together, a little shotgun wedding.
Yeah, and then I don't know if you saw the All In podcast. At the end of the All In podcast, David Sachs, I don't know what he's worth, but I'm sure it's 9 figures. He apparently owns a building that his commercial building that his financing is coming due.
Yep.
If I remember the numbers correctly, he has a $9 million loan on it that he needs to refi. Obviously,
Yep.
commercial real estate. And I think this is an office, so it's like the spot that's hurt the most. It might be mixed
Yeah. The
use,
epicenter.
but I don't think he actually said. But let's just say it's office. So he went back to a bank and said, "I want to refi the loan." They came back with a loan at 2.3 million, and then they were going to give him the other six, basically as margin collateral against his portfolio.
Okay.
So again, he's got a big wallet. He's actually just going to pay it off because it's not worth his time to deal with this. So it must be nice to write a $9 million check. But what this goes to tell you is all of those people that are these just newbie operators or whatever, they're going to go back to a refi because they were doing value add bridge debt and the time is wrong.
Right.
The bank's going to say, yeah, I know we gave you 9 million the first time, but we're only going to give you 3 million this time. What's the guy going to do? He's
Not
going to go
everyone's
get a
cut a $9 million check or a
no,
$100,000 check, even.
no, or they're going to go to their LPs going, hey, I need 6 million bucks. We're going to lose the building. The LPs are going to go, bye.
Yep.
It's yeah, it's commercial. The lending market for commercial is in the other thing, it's just starting.
Yeah.
The
Yeah.
pain is I can sense I getting more and more communications from people offline that are like, you have no idea how right you are. The pain is growing. LPs have lost everything and they just don't know it yet. It's
Yeah.
bad.
These are the definition of a margin call. It's
Exactly.
what it is. It's a margin call. We've seen margin calls play out in bad equity stock markets, and this is a margin call in the commercial real estate business.
I guess the last thing to think about, again, I'm playing with this in my head in real time, former rate hikes. All of these unicorn companies that were worth $1 billion and don't have product market fit and don't have cash flow positive, they're just going to go bust. They're going to be sold for pennies or close the doors. I mean, they can't survive at 10% loans.
No, they can't. And that's exactly what's happened to the private equity market. The private equity market, have you seen an IPO this year? You've seen like
No.
3, right?
Yeah.
Because companies can't finance the front end of it in order to get it big enough to then bring it public. And what it does is it creates bigger moats around these bigger companies because, again, they have the cash flow to sustain their operations, and the new entrant into the market that would compete with them historically is now not there.
Yeah. Crazy. So again, I cannot imagine 6.5 funds rate, 10% mortgages. I mean, that literally causes my brain to hurt. But yeah, I got to find this article and see what he's talking about, because that would be.
I'm sorry to be the bearer of bad news. I'll send it to you.
I don't mind bad news. I like reality. And again, the beauty about interest rates to me, Taylor, is a 10% mortgage rate affects everyone.
Oh, no doubt.
It's not like, hey, it hurts Taylor and Mike. No, 10% hurts everyone. So me, as an aggressive young man who likes to write stupid offers, I'm willing to go find that person that has to sell, and I'll just make the numbers work at 10%. So it's hard for me to hear, but it also makes me very excited because I know doing the work is going to pay off, because most people, Taylor, give up when it's hard. I double down.
That's awesome. And that's a testament to what you're doing and being a good operator, because what you're not going to do is go in there and offer the same price you would have offered at 3% mortgages or whatever the mortgage price you were getting before. But they are going to have other offers.
Dude, I don't pay list price ever.
There you go. There you go. I love it.
Where can people find you?
Yeah, find us at Life Goal Investments. We're on both Instagram and on TikTok.
Folks, you got to pay attention to video number 3. We're going to talk about why Wednesday after market close is the most important day, probably for the next couple of months. Taylor, thank you so much.
Thanks, Michael.